Want to just give a little background for everyone out there. And I find myself doing this a lot, Alex, in the self-storage space, but I want to kind of give people an idea of how I met you. Obviously, my role with Shovel Ready Storage within Legacy Developers is to go out and find other developers that might be interested in developing some of our sites that might be overfill for us if we have too much going on. I connected with Alex and actually someone who works with him, Mark Bukich at StorageMart. I got a chance to meet these guys out in Orlando a year ago at the Spring SSA show in Florida back in 2022. And Alex, I'm just going to tell you, I think your dad was in the room with us, and you guys didn't know me from a hole in the wall. I'm an absolute nobody in the self-storage space. I have done nothing at that point. I cannot tell you how amazing it was to be treated in that room like I was a somebody, like I had something of value. So I just want to tell everyone that's listening, and absolutely thank you, as I would say, you guys were so kind and so willing to offer your help in a way. It was really kind of mind-blowing. So just want to recognize that before I dive into all the crazy amount of things we have to talk about.
Well, I really appreciate it, Thaddeus. We, in this business, one asset is, we have 300, but there are a lot of owners that just have one, and that's their entire livelihood. And to them, that is, absolutely something that makes them somebody. I like to say we're in the business of taking care of other people's businesses when they're done with them. And that's kind of where I can step in and take over. Understanding that the decision to part with, in many cases, that one facility is actually that owner's entire life's work, is a really emotional decision. And it's something that it's not just financial. And I think that's where I think StorageMart has been good at making relationships.
Oh, I appreciate that. I just want to put it out there. You are a member of the third generation of your family. StorageMart got into self-storage in 1972, which I'm sad to say was only a year before I was born. But it's almost 50 years that you guys, more than 50 years now that you guys have been in the storage game. You're the third generation, and I got to tell you, man, like there's kind of a bias in America that kind of says people in the third generation of a family like yours tend to be cocky and egotistical and not helpful. You've been the exact opposite of that, super humble, willing to go out of your way to help. And to what do you attribute that within your family?
First of all, thank you. I really appreciate that.
I'm done giving compliments for the rest of the interview, by the way. I'm not saying anything else nice.
Yeah, I think, on some level, like you mentioned, generations of family businesses, I feel like it's almost a mantra around here that we remind ourselves of, that, the first one creates it, the second one really makes it, and the third one burns it down. And we don't want to be the third one that burns it down. I work with 7 first cousins as well that I don't think you've met thus far, maybe 1 or 2, Thaddeus, but we all find a way to get along. And there's really outside of that, I do work with you mentioned my father, but his 3 siblings are also partners in this business, and they all have different roles. There's really no room for ego when 13 people all share the same last name in the home office, on some level. But even beyond that, I think it really all started with the founder. My grandfather Gordon Burnam. He a true rags to riches story. Grew up born in the Great Depression in a very small town in central Missouri, with nothing at all. Tried. I think the number that Mike told me most recently was we've been in about 40 different businesses over the course of our family career. Only 2 of them have ever made money, and we're still in those. So it's self-storage, and we have some mobile home parks actually here in Columbia as well. That's might be the only business better than self-storage out there, but that's for a different podcast.
That's too funny.
I would say it all started with him. His beginnings, his upbringings. He instilled that kind of hard scrabble beginning into all of us, and required us all to, I think my first job was I was 14 years old working at a StorageMart location here in Columbia, Missouri. And my job was just sweeping out the vacant units when people left. And that's how I started. And I pulled weeds around facilities. We all had to do that and work outside in the heat before we ever got a shot at coming into the home office and doing anything. And that was something that, as I've looked back on it, I'm much better for being forced to do that. And it really gives you a lot of appreciation at the end of the day when I'm doing something like putting a pro forma together and thinking about the takeover process. I mean, I've swept those units before. I've pulled those weeds before. I've done that, and that I think is what I would attribute to. It gives you empathy for people, at the store level.
I love that, man. And it absolutely has rung true. And all of my interactions with you, it shows. And it's super impressive that your family has made sure to understand what are the pratfalls, what are the possible downfalls. I'm going to get into some stuff now that I want to talk to you about. Before I get into the little deeper questions, I kind of want to ask you, when did you know? Like, you obviously were born into the Burnam family, that StorageMarts have been a big part of your life. But when did you know this was going to be a path you were going to go down and you were going to be a full-fledged member of the team and jump into it as a career?
It's interesting. At various ages, I would say I definitely knew. And, as you kind of go through that as a young person, discovering yourself, thought, no, I'll never do that. Yes, I'm going to do that. I'm destined to. Oh, I refuse to ever do that. I would say that was certainly a battle from ages, when you're going to college and you're away from your family, you're thinking, well, I'd love to go out and make my own mark. But ultimately, I think on some level, it was always just kind of the plan. I don't know if I could ever point to one moment when I thought, oh, this is what I'm going to do. I mean, it was just what we talked about at dinner on Sunday nights around the table with my brothers and mom and dad. I mean, it was just part of being who we were, and largely part of my identity growing up. Frankly.
Love that. And I'm going to kind of use a little bit of StorageMart's experience now. I want to dig into what's going on. The big news in self-storage right now is obviously Public Storage made this offer for Life Storage. Yeah. We're still kind of hearing whispers that Life Storage has turned it down, but maybe there's still some stuff going on behind the scenes. I really want to kind of create a little bit of the understanding for our audience of how your family really maybe understands this situation more than anyone else.
Yeah.
StorageMart wasn't always a privately held company. You are now, right? You're family owned, but you were public in the 90s and have fallen victim to this. So take me back to the 90s and, tell me what happened with that situation and how you can kind of relate to what's going on.
Yeah. It's a really good point. It's almost an identical situation. But we were at the time went public in 1994 as a company that was called Storage Trust. At the time, I believe we had about 35 or 40 locations, and then took that and raised money in the public markets and grew it to a portfolio of about 255 locations in 1999. And really, the story goes, on a Friday, you had some attorneys from California show up and, here in Columbia, Missouri, and inform us that Public Storage had acquired a significant stake in our business, and that they're making a tender offer for all the remaining shares of the company. And really, by Monday, the deal was done. As the story goes, we had 500 employees, and then, 5 that we were all related to, the next week. Public Storage, honestly, it's a tough thing for me to say, but honestly, to their credit, I think they are brilliant business people. I think that they have a knack for identifying timing, and I think that their balance sheet is so unbelievably strong that the time, the place, and the price and the way they structured the deal for Life Storage. I don't see how it doesn't get done. Frankly, I look at where Life stock is still trading today. I would argue that the market still has the deal priced in. You can see that they had an intraday bump when the deal got announced, and regardless of the fact that LSI's rejected that offer, in writing. The stock price still indicates that the market thinks that this company is going to sell. There's obviously a lot that's happened in the last 2 or 3 days that might, throw a wrench into that whole situation, in the macro economy. And we can get into that here in a minute. But, for what it's worth, Public Storage's offer did not require any debt. So, when I'm looking
Right.
at the debt markets that are out there today, not necessarily relevant to Public Storage's ability to execute on this deal. So you could even argue that the extreme volatility since even Friday actually may have helped them. And yeah, the timing could not be better.
Couldn't agree more, right? Really hard for shareholders, many of whom are of course, there's so much volatility and uncertainty, to turn down what amounted to, I think it was like a 19% premium over what the share price was trading at when the offer was made. Really hard to convince your shareholders that that's not a good thing to take when the rest of the economy is not in shambles. I mean, it's not falling apart, but on the flip side, there's so much uncertainty.
Yeah, absolutely. I saw today that there was even a brief, stall in the market for, U.S. Treasuries. You say if I can't buy and sell U.S. bonds, good luck raising, X billion dollars to go do an LBO of live storage. I think that's going to be a tough one right now.
Yeah, I couldn't agree more. I think that's a super observant point, that it didn't hurt Public Storage's position in any way, shape, or form to have that uncertainty.
Yep.
So let's kind of dig into this, because it's been a really interesting, 8 months, really a couple of years, because obviously 2021, we really started to see some crazy, we obviously do a lot of ground up development, right? We go out and identify raw land, and the land speculation, like what we were able to get a piece of land for in 2021, by the end of the year into 2022, it was really insane. And we didn't really see that shift just because Jerome Powell kept standing up and adding 3/4 of a point or half a point to the interest rate. How do you do business in that environment where the land cost is so crazy, but the debt market is so uncertain?
Yeah, I mean, especially development, Thaddeus. I mean, you talk about, acquisition's one thing. I mean, I only have to have my, pro forma and interest rates sit still for 30 to 60 days before I close.
Right.
If you were tying up a site, chances are you're a year, if you're lucky, out, from closing.
In a good county.
And I bet during all that volatility, you had a hell of a time getting your contractor to commit to a fixed price bid on your building package too. That was the answer is really hard. You have to work, constantly communicate, with your investors. I would say that we basically during 2021 and really into 2021 was when it was the absolute hottest, and interest rates were still, when in December of 2021, when we closed on Manhattan Mini Storage, we got debt that started with a 3, and that's wonderful. And, you could do that, and, property values just kept skyrocketing in 2021. 2022, it's been really hard to price anything. And that's a result of, to your point, the volatility of interest rates. It feels like, over the last year, I feel like we've always been 6 months away from a recession. And that continues to be the headline every 30 days. We're 6 months away. And then the inflation read comes in and everyone panics a little bit. They jack the rates a little bit. Nothing changes. Everything starts plowing forward. And, the volatility makes things really difficult to price assets. Not only on the interest rate side of things, you have to worry about increasing rates, but really it's the credit spreads too. If you're borrowing floating rate debt, removing, if the world had in 2021, I could borrow at SOFR plus 215 basis points. For the exact same loan in late 2022, I'm getting quoted SOFR plus 280 to 300, and that's a direct reflection of volatility in the marketplace, where anyone who is originating a loan wants to be compensated for that risk, and caps and swaps are incredibly expensive as well when you're working through that. What I would say is, especially for development, Thaddeus, to answer the question, I know this is a long answer, it's contingency in your budget, but I think if you started a deal and, maybe 12 months ago, you thought, wow, 20% contingency, surely that's enough. And as hard costs kept going up, oh my gosh, this has ballooned 30, 40% over what I thought it would cost to get my steel to, get, what I needed. And that's a tough decision. I think having great relationships with your lenders, invaluable. I would say that if you're in the real estate business, you're in the money business. That means you're in the debt business, and you need to be your banker's best friend. I think back to a quote my grandfather always told me was, "You should have one God and two bankers," because chances are one of them is going to ask you, "What have you done for me lately?" And you got to have great relationships with the backup. We started to get a little bit of that. Lenders that you've done quite a lot with, all of a sudden have to face their credit committees, and they're getting really tough questions, and those filter down to you. And if you've got a great relationship with them, and you should be able to navigate those rough waters. But if you're starting a fresh relationship with the lender, getting them to through the KYC process and understanding who you are, I think it's a bit of an uphill battle right now.
So I think that goes to a place where I really want to talk about. I was talking about how nice you are at the beginning of this, and then all you keep doing is telling us as developers how much of a tough spot we're in. We've done all these things in the last year. I'm like, Alex, stop digging the needle in, man.
Sorry.
No, it's perfectly okay. And quite frankly, I think this is why we're so happy that we're in self-storage, because even though none of this has been fun, it's all it's painful. At the end of the day, we're in an asset class where there was enough meat on the bone of all these deals that we bought that we're going to get out the other end okay. And I think what we're really seeing here in the last 4 or 5 months for us, it's actually been easier for us to raise debt on some properties than it was a year and a half ago. And how excited are we that we're in storage, where when these things tend to happen, the word recession proof gets thrown around. I don't want to use that necessarily, but definitely I would say a track record of overperforming other asset classes in the midst of volatility.
Yeah, that's a great point. That is, it's I like to use the word recession resistant. But
yeah, that's a much better way of saying it. Leaves us a little out.
But no, I mean, like, to your point, I think the institutional world has identified self-storage as a safe haven real estate asset class, and that was evident yesterday. If you looked at the stock prices of all the REITs as these banking stocks were falling apart yesterday, Public Storage was up 5% intraday yesterday. Extra Space was up 2%. QSmart was up 3%. I mean, they came down a little bit, today with the market, but largely in line with the S&P and Dow. I thought that was kind of interesting, where you would see maybe a little bit of rotation of capital into an asset class that's viewed as, safe, quote unquote.
And I guess one of the things that's so interesting to me is that while it kind of has that moniker of safe, it's not just safe, right? It's safe and incredibly high performing over a really long period of time.
That's right, actually. The statistic that NAREIT likes to trot out in front of everybody, and this is true, is over the last 25 years of all real estate asset classes, self-storage has had the highest annual average rate of return at the lowest standard deviation of that return. So quite literally the best returns at the least amount of volatility of any form of real estate you could invest in. I mean, how does it get better than that?
Yeah, it's like living in Hawaii, right? You get 86 degrees every day, but it never deviates a whole lot from 86 degrees. That's a perfect way to put it, right? Fantastic. I want to go back. I want to rewind a little bit, and because you kind of touched on it, but you really brushed right over it. You guys made a pretty massive acquisition of Manhattan Mini Storage late 2021. A big addition to you guys, and I always find this really funny. You're in Columbia, Missouri, which University of Missouri obviously is the centerpiece of that city, but not exactly where you kind of think of an $8 billion company being centered. and you buy Manhattan Mini Storage, kind of the economic center of the country. How did that come about? What did it mean for you guys as a company? Take me down through that story a little bit.
Yeah, sure. I mean, Manhattan Mini Storage, for anyone who's been in the self-storage industry for a number of years, it's a iconic brand. Have been known. I think back in the '90s, they're featured in a Seinfeld episode in the '90s. I mean, this brand has been around.
Wait, were you alive when Seinfeld was on, Alex?
I was pretty young, but I have watched it 3 or 4 times, so I know my record. But it's a long-standing brand. First and foremost, and frankly, one that nobody ever thought would ever come up for sale. Kind of one of these crown jewel real estate portfolios really on planet Earth. When you look at what it is, 18 parcels on the island of Manhattan, and they're all free and clear without leases. Really what precipitated that deal, I think, has to go back to the beginning of 2021, which, 2021 in self-storage was the year of the mega deal. We had, I think, 4 transactions trade in this business that were over $1 billion. So you had the Easy Storage transaction, which was, I think, 52 locations throughout Washington, D.C. and Baltimore. Maybe the second best storage portfolio in America. I mean, we bid on that one and we lost. We wanted it because of how great the real estate was. Over the course of the year, we also saw the Advantage Storage portfolio and Dallas-Fort Worth trade. That was a public storage transaction, I think, maybe $1.5 billion, 55 locations around Dallas. And then, when those 2 deals traded, the cap rates got out, everyone heard about it. And I think the family up there started thinking about it. And they thought, wow, who would have thought this income stream could actually be worth that? They announced the deal. And as fate would have it, we were actually, in person with our partners, having a meeting at that time. And, we all kind of actually joked about it a little bit, kind of saying, hey, could you imagine if we did that? And a few days later, started having some serious phone calls about it. And ultimately decided that it was worth our time to go visit the assets. We couldn't be hurt by doing that. And really, it was the real estate. It spoke for itself. When you go and you see these things, and you see the locations that they're in, and the type of neighbors that they have, and frankly, the rental rates are, I think our in-place rates are about $99 per square foot annually.
Holy goodness!
So over $1,000.
Which, just to give some perspective to people that are listening, we are happy if we're underwriting a new development site and we think we're going to be above $20 a square foot at stabilization, right? So you're talking about 5 times what we would consider a developable price. Obviously that's based on pro forma from our side. You got real dollars of $99 a square foot. That's hard to fathom.
It is. And when we looked at it, we almost had to second guess. I couldn't believe it at first. Because we actually, prior to that deal, we own 3 properties in Brooklyn and Queens, 1 in Secaucus, 1 in West New York. So we were, we're familiar with it, but it never touched Manhattan. And, really, even in Brooklyn and West New York, the rents drop off by 50%. It's $40.
Yeah, I was going to say, you weren't getting $99 a square foot.
Yeah, that's right. And the average unit size at these properties is 35 square feet. So, these are really small units at really high rates. A 10 by 10 would be a mega unit in Manhattan. That's a commercial unit. That's a business user probably who's renting a 10 by 10. I would say 40% of them are 4 by 4 by 4 cubes that are stacked on top of regular height units. And the buildings themselves are very different than, the type of self-storage facilities that, you would typically envision. At one location, I have 8,000 units. So if I'm I like to to convert it to Kansas City, because that's my biggest market outside of Manhattan in the United States. If the average location in Kansas City has about 600 or 700 units, this was the equivalent of acquiring 95 of those at once. So this was
how many net rentable square feet in those 8,000 units, if you don't mind answering?
yeah, it was a 2 million net rentable square foot deal.
Hey, that is absolutely crazy. That was the whole portfolio, or that was just the site with 8,000 rentable
Just the
units?
self-storage. So, I mean, some of these are mixed use. I mean, there's two of them have some floors with kind of a WeWork type product called office workspaces. We have some commercial tenants at a few deals. Like there's a property at 220 South Street that is on the far, east side, south end of the island that we rent a giant parking lot out to Verizon, and that's where their brains are for all of Manhattan and their facilities and their trucks. I mean, it's very interesting uses that you wouldn't really anticipate. I post closing, we've had interesting opportunities come our way. Cell tower companies that want to put 20 5G arrays across all of our rooftops. These billboards that are renting for prices that you can't imagine. But it really was the real estate that is at the end of the day. You tour these assets, you see what's there, and you think this is a once in a lifetime opportunity. If you can find a way to make the numbers work, you got to do it. And if you can believe it, in our view, they were not really managed by the standards that we would manage our properties. This was a very big operation that was all of these sites were developed or converted by the original founder and principal. His name's Jerry Gottesman, who's a really brilliant New York developer. I wish I could have met him, but he passed away I think 5 years ago, and I think that in the time since, not as much innovation had occurred in those 5 years, and we saw some upside that we could capitalize on right away. And
I think for it. Yeah, I think it's one of the reasons I love capitalism, right? Because when you're making $99 a square foot rents, there's not a need for doing some of that work, right? If you're making that kind of profit off of your facility, you're not incentivized to have that innovation. But when you guys come in and you pay a premium for that product, you have to find ways to improve it, right? And so you get that innovation that becomes necessary through the price you pay.
Yeah, that's spot on. That's spot on.
So I'm gonna again rewind because I thought of a question that I really want to ask you guys. Public Storage does a hostile takeover of you guys in 1999. You go from, as you said, 500 employees to 5. I think you went from somewhere around 250 stores down to like the teens, right?
Yeah. So, at the time, the sale, instead of taking stock, Chris and Mike took 14 locations that didn't get included as part of the sale that, frankly, were the ones that didn't compete with Public Storages at that time. And
Got it.
that was the easy way they cut it. If you want to stick a needle in me, you can go back and look at what the share price of Public Storage was in the year 2000, Thaddeus, and you can do the math on if you'd rather just held stock or kept those 14. But hindsight's 2020. They took those sites out, leveraged them, and went straight to Wall Street. And we raised a $100 million development fund with a private equity group called Warburg Pincus, who were our backers as we went out and did nothing but build. So the strategy was from 2000 really up until the GFC, go to gateway markets. So those properties in West New York and Brooklyn and Queens that I described to you earlier, those were all development deals we did back then. Our 10 stores in Chicago, all development. Miami, Kansas City, Oakland, San Antonio, a few around the DC area. And it was all building, all through the GFC, till the GFC.
I just did a little quick Google search. $13 was the Public Storage, and for those of you who don't follow stock prices in the self-storage space, they're trading in the 300 range right now. So like a 30 multiple, 25, 30 multiple. So yeah, maybe. But here's what I would say, and this is actually why I prefaced this question to begin with. You guys, man, a lot of people would have turned it in. There's a lot of business owners who would have been crushed by that buyout. Maybe would have taken the stock. You guys and your family go from 250 stores to 14, but then now you're even bigger. You have 280 stores now. I guess maybe take me down kind of, and I guess your earlier conversation about you as a third generation and kind of the way your family thinks maybe is an answer to this, but how do you rebound from that and come back even stronger, I guess is what I'd want to ask.
Yeah, I mean, it's an interesting, I think to some degree at the time, the decision was personal. It was, how could we possibly, allow these people that, came in and took this from us to, continue to manage our wealth going forward. I think that was, that was probably part of the decision process, and a little bit speaks to the entrepreneurial nature of who my grandfather was, and not taking that lying down, and it was interesting. We knew a lot about self storage, and we had those 14 stores. We knew where the best locations were, and we said, well, let's go out and we'll build there. And we did deal after deal after deal. It reached a point in 2006, 2007 when Warburg wanted their money back, as private equity does, by the way. Anyone who's signing up for 5 years, you're gonna have to pay them back at some point. And so we went out to sell the company, and we were going to stay in but sell out their equity. And we did about a year-long marketing process and couldn't get the price that we wanted. But honestly, through a connection in this small town of Columbia, Missouri, our family attorney had a client who's also from Columbia, Missouri. His name's Stan Kroenke. Stan is maybe most famous today for being the owner of the Los Angeles Rams, but is was one of the original developers of Walmart supercenters back in the 1980s after he married Bud Walton's daughter, Ann Walton, and in the time since then it's more than tripled her fortune. I mean, he's been one of the most successful real estate businessmen in the United States, but he's from Columbia. We shared an attorney, and he set up a meeting at believe it or not, a Panera Bread here in Columbia, Mo, between Mike and Chris and Stan, and that's where we cut the deal. And Stan stepped in, bought out Warburg, and has been funding our growth ever since. And the funny thing about what public did to us, you learn a little bit. In 2008, the funny thing about Stan's one of the biggest landowners in Canada. He's heavily invests in Canada and had been telling us for a long time, guys, you really got to do storage deals in Canada. The market's great up there. No one really knows what they're doing. And so we started trying, and we kept getting outbid by this company out of Toronto that was, coming in and paying 20% above what we were offering, prices that we couldn't make sense out of. And we started studying it a little bit, and taking a page out of Public Storage's handbook, we started buying their stock. In 2009, we launched a hostile takeover on the largest private or publicly traded storage company in Canada. At the depths of the GFC, kind of convenient timing, kind of similar to a time maybe right now when there's not many other competing buyers that can show up, and you've got a billionaire who can write a check. And we took that company down for $400 million. Last year it appraised for a little over $1.5 billion. So that was a pretty good deal. But overnight, we conducted a hostile takeover on that company and ended up with our 68-store Canadian portfolio. So, it was kind of a full circle moment, if you think about it. Having been on, the receiving end of that, and then to do it yourselves. So I would say that's really where the bounce back occurred.
You brought up something that's so important to us. You may see the Storage Syndicate logo there. We've launched a mastermind that we do. We just had a couple of day event in New Orleans. I had one in Vegas back there. And the importance of connections and having a network and having other people. And obviously Stan Kroenke is not known around the world. Anyone that follows football knows who he is now because they built SoFi Stadium, and it's the Taj Mahal of arenas. They just had the Super Bowl out there a year ago. But he's not known in self-storage, but you had this connection. And so talk to me about how important networking has been, and maybe goes to why you were so kind to me, because you just don't know where something's going to go.
Networking is how I do 90% of my acquisitions. I would say 9 out of 10 of the deals I do are off market without brokers. And that's a direct result of hard work put in networking. Now, admittedly, I kind of did step into a pretty good, machine here in reputation to trade on. But it does require hard work. I'd say once every year or two, we'll close on a deal that, started as a lead in 1982, because Mike, met someone and, advised them and helped them through their business. And, when the time came for them to sell, they thought of him and called him first. And that, I think, is the secret. We're an open book. We've had a lot of help from other people in this business. We want to help other people make money in this business. And at the end of the day, it's a 3-mile trade area. Thaddeus, you're not my competitor. You don't have a store that's anywhere near any of my stores, right? So it doesn't matter to me at all if I help you make money. And down the road, if you can find you've made a lot of money because of maybe some advice I've given you, and maybe you think positively of me, you'll give me a call when the time's ready to exit, and hopefully I can get you a price you like. And that has generally been our MO. So we, at a lot of our SSA presentation, we support the SSA very heavily. We donate to it. I serve on as many state association boards as I can. We have members of our family on the national board. The more we can share with each other, I think helps everybody. Now, if you built right next door to me, I'm probably not going to like you very much.
So listen,
you're a nice guy.
We got a few minutes left, and I definitely want to give you a couple of minutes to dig into you guys are going into a management platform now, which is a new thing that you guys have decided to do. Before I ask you to kind of talk about that, I want you to just give me, you mentioned how we're not competitors. I hear from people, hey, is storage starting to get oversaturated? Give me sort of your macro outlook on where self-storage is and what you see happening in the next 3, 5, 10 years.
Yeah. I think the big headline, and probably a lot of people have heard it at this point, but I think it's the return to seasonality. This business before the pandemic, reliably your peak occupancy was in the summer, and your trough was in the winter. And if you think about it, I don't know the exact statistic, but I guess probably 3/4 of leases in the United States for apartments roll on May 31st. Or April 30th. That's moving time in America. I think America moves in April, May, and June. When you look at occupancy and self-storage, is directly correlated with that. That relationship went away during COVID. We kept seeing, occupancy didn't go down when the weather got cold, later on. And that was a bit of a shift for us. During those 2 years of COVID, it kind of became a game of, I can't believe these rates keep on going up. I guess I need to keep raising them because I haven't found the ceiling yet. That was never in our playbook before 2020. And we're having to dust off our old playbook right now. I would say that we operated the way we've always operated, but it's more of a focus on occupancy, I think, is going to be the one that everyone's looking at. There's a bit of a slowdown in operational fundamentals right now, but, I think it's the difference between having an excellent year and a pretty good year. I mean, what we're talking about, going back to the 25 years of, the highest annual returns at the lowest standard deviation of returns. I mean, you dig into that data, I'm pretty sure only 2009 was the only year that had a negative number, throughout those entire 25. So it's not to say it can't happen, but, I think the new headline is slow and steady growth the way it used to be, 3 to 5% NOI growth on stabilized assets on an annual basis. If you acquire something with upside, you eliminate that upside, and then, you clip along, down the road. I think it's a shift to more realistic return expectations.
Got it. We're not going to see 61% growth again over a course of a 2.5-year period like we did from the start of COVID to the end of
God,
last
I
year.
hope so. But if I were a betting man, I wouldn't bet on that. It's interesting though. I do think a big change though, and this is probably a secular change coming out of COVID, is the global institutional world of real estate and how portfolios are being allocated. So, before COVID, an office asset was safe. That's, A plus,
Right.
CBD Manhattan, can't go wrong.
Yeah.
Now, if you go to these NAREIT conferences, they are literally cracking jokes at the office people that are there. I mean, it is a bloodbath in the office space. The retail space got a lot of, a black eye on it over the last, 5 to 7 years with e-commerce. I think that's largely shaken itself out. You look at, there's clearly been some winners and losers. I think people have, I would say the accelerated fall of retail is probably slowing down a little bit. And it's more office that, there's a lot of money invested in office. And, when you're talking about the rotation of money into safer asset classes, self-storage, through COVID got every headline. We were the star child, right? So I think a lot of fund managers are looking around saying, well, even if we are going to enter into a recession, that actually might drive more money into chasing self-storage deals. So
I got my fingers crossed over here, Alex.
I feel good about it. And honestly, I think the evidence of it is there when you look at cap rates, over the last 12 months. The fact that interest rates have gone up as much as they have and cap rates have really, it's a little geographical. So, these, New York City, these top 50 MSAs, Atlanta, Miami, cap rates really haven't changed that much. It's maybe 25 basis points, of erosion, but they're perceived to be pretty safe assets to still invest in. I think money's still chasing them. Now, I will say in the secondary, tertiary markets, I think cap rates have unraveled pretty quickly. We do a lot of business in places like Omaha, Des Moines, Kansas City. Before COVID, we could reliably get a spread of 125 basis points, 150 basis points in cap rate to do a deal in Omaha as opposed to, Washington, D.C. During COVID, I think that spread collapsed to maybe 50 basis points. It was so hot. People were thinking, well, I'll buy something in Oklahoma City for, a 5 cap, or something like that, right? I think that has reverted a little bit back to the norm. But when you look at valuations in these big cities for stabilized product and good locations, I think it's still largely holding up.
I just wanted to say that maybe you lost 5 years of your NOI and the sale price, but on the flip side, the cash flow from the facility is still really strong. So not to be scared if you're in a secondary or tertiary market, maybe you don't get the sale price.
Right.
But StorageMart isn't looking at selling these things. You're hanging on to them because the cash flow is such a win.
That's right. Yeah, we don't sell our assets. We're actually structured as a private REIT today. So it's a perpetual motion. It's a perpetual vehicle. We're not underwriting exits on any of these deals. We're
right.
This time around we have 20-year money because we learned that 5-year money just ain't long enough. The time won't come to having a quote unquote going out of business sale for quite some time. So we're excited about that.
So it's been so engaging and your answers are so informative and well-spoken. This 45 minutes is already gone and I hate to take too much extra of your time, but I do want to give you a chance. You guys decided to jump into the management game. Tell me a little bit about your management platform. I know I had a question in here from Martin May saying what kind of differentiates you from, the CubeSmarts and the Extra Spaces of the world. Tell me why you decided to get into management. And what is it that StorageMart thinks they bring to that table that might be of greater benefit to an owner?
Yeah, I think my answer is going to be largely the same as, most people who have gotten into the management business. On some level, there are markets where I know I can provide a lot of value. In a place like Kansas City, I have 48 locations. I have 25 in Des Moines. Markets like that where Public Storage has a few. Maybe there's a couple from Extra Space. We are the big brand in town, and there's certainly demand for that. I would say that at the end of the day, though, I'm not going to put up a smoke screen here. It's intended to be an acquisition pipeline, hopefully one day. I think that I don't want to manage any store that I don't intend to buy down the road. I think CubeSmart and Extra Space would tell you the same thing if you ask them. Our fees are absolutely competitive with where they are. We're intending to launch a competing product. We offer operations that are on par with what the REITs are doing. But I would caveat a little bit in saying that it's a little bit of a bespoke product, and that I'm going to be a little bit picky. If you bring me a site, like I said, Oklahoma City, I don't have any locations in Oklahoma City. If you called me and said, "Hey, will you manage this location in Oklahoma City?" I'm going to say, "Sorry, bud, I can't help it. You should call Extra Space." I don't think many other of our competitors are going to say, "Hey, go call the comp. He's your better choice." At the end of the day, I don't want to manage any properties that aren't within a 90-minute drive of one I've got right now. It adds on the expense side for my existing assets. There's absolutely synergy and economies of scale.
Right.
I'm only bidding on one brand in Kansas City on Google. So adding one location under that brand, that almost costs me nothing in advertising spend. So that is that's powerful. And then really it's rates. Asking rates, and to an extent helping developers not make mistakes might be a way to put it. I can't tell you. There's quite a few times I'll be approached with a certificate of occupancy deal, or some type of development deal, and someone's put together a unit mix on there that's maybe 30% too small for what the market requires because it looks really good on paper. Maybe they didn't. I'm thinking there were two deals we did in Kansas City in 2021 that was a developer out of Texas that came up. They did two CO deals, and they didn't do pull and loading bits. And we kind of had to step back for a second and say, guys, it snows up here. I understand it doesn't snow down where you're from, but you've made a grave mistake. And we've bought these new deals. We take can openers to them. I want to get in on day one. So if I'm in a market, I want people from my people looking to build in my market to reach out to me and talk to me and say, "Hey, I'm looking to do a deal," and I'll say, I promise I'm not trying to talk you out of doing it. I just don't want you to make a mistake here. And this is what I would do. Whether or not they want to listen to me or not, but I think there's added value to my portfolio. When everyone in the market's making good decisions. In their unit mix design. So, I don't want to fight you on the way to the bottom on asking rates, because you got 100 5x5s you can't lease. That's
right. That makes perfect sense. It does you no good to discourage someone from building something in a market where you might like to own more assets anyway.
That's right. I think I think it can be a symbiotic relationship, and that's kind of our goal with it. In New York, in particular, leveraging the Manhattan Mini Storage brand and how valuable it is. I think there's some upside there as well. We've certainly been talking to a lot of people, on the island about using our brand.
So listen, man, it's 7:50. I've already taken 5 extra minutes of your time. I want to thank you so much for joining us. You were so knowledgeable and insightful in your answers. Can't thank you enough for sharing so much with our audience and with us, for that matter. I see you rocking the Mizzou shirt. I know they're playing in the NCAA tournament here. I know you're kind of a follower of the Mizzou Tigers.
Yeah, that's right. We play Utah State tomorrow night. And, despite the fact we have a higher seed, Vegas has us as a 2-point underdog. I don't understand those odds. We smoked Tennessee last week. So if I were a betting man, I'd hammer that spread all day, Thaddeus.
And he gives betting advice. I love it. Alex, man, thank you so much. Look forward to seeing you again soon. Thank you, as always, for just being such an awesome welcomer to me personally and to our group. You've helped us. I know you've given us that insight, without asking anything in return, and we certainly appreciate that. Hopefully we can do this again someday.
Yeah, sounds good. I'm looking forward to connecting again.